International Business School is elated to organize its Jurist Day. I, Paras Sehgal, your host for the day, offer a very warm welcome to our respected chief guest, Advocate Mr. Vishal Kalra, Senior Advisor Deloitte Tax and Corporate Law Attorney. Honorable Director Sir Vikas Nath Sir, along with Program Coordinator of BLLB, Mr. Neelam Singh Ma'am, Program Coordinator of BBLLB, B.K. Araf Sir, and respected faculty and all other students of semester 8. Deloitte International Business School was established in the year 2004. GIBS is affiliated to Guru Gobind Singh Indraprasth University, Delhi, and is approved by All India Council for Technical Education, Ministry of HRD and Government of India for technical courses, and Bar Council of India for law courses. The institute is accredited as Category A by National Assessment and Accreditation Council and assessed as Category A Plus by the State Fee Regulatory Committee, a fee committee of NCT of Delhi, and rated highest grading A by Joint Inspection Commission of Government of NCT and GGS-IBU. The institute conducts programs, courses of MBA, MBA Business, MCA, undergraduate courses of BBA, BLLB, and BBLLB. Now, let's start this beautiful day and this event by taking the name of Lord Ganesha and request him to make this event successful and bless us. Starting with the introduction of our guest of honor, it is a pleasure to introduce our chief guest, Advocate Mr. Vishal Kalra sir, who has graciously accepted our invitation to join us today. He is enrolled as an advocate with the Bar Council of Delhi and has experience of 30 plus years in top law firms such as Wage Associates, BMR Legal, and Deloitte. Welcome, sir. Sir has demonstrated history of working in law practice industry, focusing in tax and corporate law, skilled in transfer pricing, international tax, direct tax, and corporate litigation. He was an empowered advocate and partner for BMR Legal from November 2008 till September 2017. He has also handled several tax and corporate law matters as a tax corporate law attorney. He specializes in handling litigation of Indian and foreign companies in domestic and international tax law matters. In transfer pricing, he is currently working as a senior advisor in one of India's most reputed law firm, that is Deloitte. Our efforts will be to present every act with sheer honesty and respect. But before...
So, the assessing officer normally passes the order within 12 months or 24 months or 36 months, depending upon the respective Finance Act timelines that are there. Now, once the order is passed, before the dispute resolution panel, I have to file my objection within 30 days. Before the CIT appeal, again, I have to file my appeal after 30 days, or sorry, within 30 days. Now, the only difference between the CIT appeal and the dispute resolution panel is that the CIT appeal will be the appeal against the final assessment order. The dispute resolution panel is a kind of a body which is a kind of continuity of assessment. So that is, there is only a draft order, there is no final order. The final order will be passed after the dispute resolution panel directs the officer that this is to be done, this is not to be done, and then the final order is passed. So the final order won by the after the DRP directions, and the CITP order is appealable to the tribunal. The appeal for filing to the tribunal is for 60 days, the time limit I mean. Similarly for High Court it is 120 days, and then for the SLP to be filed to the Supreme Court is 90 days. Now, why an SLP? Because there will be no straight appeal to the Supreme Court. You have to take a SLP is called special leave petition. So you have to file a SLP first, then the court will grant you leave to proceed. When the court will grant you leave to proceed, then only you will be able, that SLP will be converted into a civil appeal. Otherwise, the SLP, if dismissed, is dismissal of the petition per se. So that period is 90 days, but there is no direct appeal to the Supreme Court under the direct tax laws, or even under the IDT laws. Though I have captured this, so my hyperlinks are not visible here, but I'll just move the slides and show you. So this is what I have captured, the appeal to the Commissioner of Appeals. Section talks about 246A talks about which orders are appealable, And then the liability, so this is 248 is TDS, the form of appeal is there, procedure of appeal, and powers of the CIT appeal. So as I said that within 30 days all that I have covered. So now electronic filing of the appeal is mandatory. And then the way we have to file the appeal is we have to file grounds of appeal, certified copy of the order, my statement of facts. That statement of facts is just a small, I would say 2-pager or 3-pager note on my facts, nothing more than that. Then these are just procedure requirements. And I'll leave this appeal fees, I'll leave. Then the powers of the CIT appeal is there that he can confirm, reduce or enhance also. So if he enhances, then if there is a penalty to be levied, then the penalty will be levied by the CIT appeal, not by the lower adjudicating authority. Similarly, he can also grant stay of demand if there is a demand that is pending. And then there are certain limitations. So, and similarly, this is the dispute resolution panel. The dispute resolution panel is a collegium of 3 commissioners. And so it's a bigger forum, but it is an extension of the assessment order per se. So it is not that it is similar to the CITPs. It is per se an administrative body. It directs the assessing officer that if, let's say, assessing officer has made 10 adjustments, those 10 adjustments may not be, I would say, sustainable in the eyes of law. So they would then direct the assessing officer that no, you delete this, you maintain this. So this is the role of the DRP. And then once the objections are, sorry, the directions are passed by the DRP, then by the assessing officer in conformity with the DRP directions. And after the DRP directions, the final order is then appealable to the tribunal. So this is just a distinction between the DRP and the CIT appeal. And this is the appellate tribunal. So as I said that the appellate tribunal, there is one judicial member, one accountant member. The judicial member is from the law background. It can be an advocate, it can be from judicial services. As far as the law member is, the accountant member is concerned, it can be a chartered accountant or a person from Indian Revenue Services. So those 2 categories are for the accountant member. So then there are various orders which can be appealed against. I don't think that it would be too relevant for this group per se. And then this is appeal piece. And then this is how the process goes on. Once the ITAT rules in favor or against me or the department, one can go to the High Court. Then there is 120 days to appeal to the High Court. And similarly 90 days of filing of SLP to the Supreme Court. So this is what the judicial hierarchy is. If, in case you have any questions, I'm happy to address before moving on further. Sure. So I'll move further. So as we know that every year the finance minister presents a budget in the Lok Sabha or the parliament. And so we have that Finance Act. The budget is the outflow and the inflow of whatever expenditure and the receipt would be or the generation of funds would be. And then we have the Finance Act, which gives us the guidance about the direct tax amendments. What are the policy changes that are being brought in the direct tax or indirect tax? So that is being done under the finance. So once the, first is a budget speech, then there is a finance bill, which then culminates into a Finance Act once the President gives an assent to the bill. So that's what the procedure is. Now, this year also, the Finance Bill was presented on 1st of February 2023. Now, this has been given assent to. Normally, it happens in the month of April. So there was various amendments that have been brought in this year's Finance Bill as well. So I'll be addressing those amendments before you. So the first amendment that is being talked about is the where's the pointer now, or there is no pointer in this? There is no pointer. Okay. So the first amendment that is being is the coverage of benefit of perquisite. Now, there is a benefit of perquisite under the salaries and also under the PGPP. Section 28(4) covers the benefit of perquisite under the PGPP. If I compute the business income, then you have to take this section into consideration for the computation of the profits and gains of business or profession. Now, the section used to talk about that any benefit of perquisite in cash, kind, or partly in cash and kind. But what happened was that the court started interpreting in cash that should be actual. If the actual hard cash is not to be taken into consideration for the purpose of this section, for computation of PGPP. So the actual hard cash means the real cash money. Not if the money has entered into your bank, that is normal transaction which is covered. But the actual hard cash will not be covered here. That's what the court interpreted. And the Supreme Court also upheld that interpretation. To curb that or to plug that loophole, the amendment was brought in that even the actual hard cash will be considered for PGBP, and therefore this section always meant that the hard cash will be covered. So that is what the clarificatory amendment is all about. Similar amendment has been brought for 194R, which is a TDS section, that is tax reduction at source. So there also similar amendment has been brought to deduct tax, but that amendment was brought in by Finance Act 2022, not by Finance Act 2023. So I'm just correlating the two amendments that were there. So 194R was brought in. Now then, we all know that startups are quite important for us. I'll move over here in case everybody is not able to see. So startups are quite important for us, and there's been a lot of initiative to give a thrust to these startups. Now because of that, the startups get an exemption under the Income Tax Act, which is under Section 80 IAC. Now that exemption was available when a startup was formed or is to be formed by 31st of March 2023. Now they have extended the timeline that if a startup is formed by 31st March 2024, then again that startup will be eligible for exemption under Section 80 IC. So that is one amendment which is a welcome step to boost these startups and give them the impetus of the exemption which is available under Section 80 IAC. Similarly, because the startups get the exemption for a period of 3 years within the block of 10 years, that comes under the first bullet that I was checking, means second on the slide. But for the losses which the startups were carrying on or carrying over, the depreciation or the brought forward losses, that was only for a period of 7 years. To rationalize the two provisions, that is the 80 IAC term of 10 years and the carry forward of losses, this was rationalized and synchronized. So there also the 7 years was made to 10 years. So that is the second amendment for the startups. Then the last bullet is about the presumptive taxation. Now presumptive taxation is that where is basically for small traders or let's say transporters or professionals like me and other professionals. Like for the transporters or traders or small businesses, if the limit is 2 crores, one can opt for presumptive taxation. That is called an eligible business. Now presumptive taxation is wherein you pay taxes on your profits, that is the gross turnover, at 6% or 8%. You don't have to maintain any books of accounts, no vouchers, nothing, just pay tax of 8% or 6% of your gross turnover, and the matter ends there. And even the tax department will not run after you for that presumptive taxation scheme. That limit has been increased from 2 crores to 3 crores. So basis that, now a person who is having a limit of 3 crores can come under the presumptive taxation scheme. Similarly for professionals, that gets covered under 44A DA, wherein the limit has been increased from 50 lakhs to 75 lakhs. So professionals like me or any other professional like doctors or XYZ can be covered under this scheme if they have a limit of 75 lakhs or the gross profits are 75 lakhs. Sorry, not the gross profits. Gross receipts are 75 lakhs. And also in case of professionals, the 50% of the gross receipts are to be shown as taxable income. In case of traders, it is 8 or 6% of turnover. But in case of professionals, it is 50% of your receipts. That is to be shown as income. Similar amendment has been brought in section 44AB, which is, as I said, that once you opt for presumptive taxation, you don't have to then go for any books of accounts or any other formalities under the Act. One formality under the Act is to file a tax audit report, which is 44AB section. So that formality is also not required. So these are the amendments for rationalization of presumptive taxation, just to broaden the tax base. And it's a welcome thing, but only thing is that as far as this 75 lakhs of professionals limit is concerned, this could have been a bit more, like maybe a crore. That could have been a better proposition. 75 lakhs is too low per se. Though I don't think any successful lawyer or even qualifies for this. Moving forward, so there was a scheme of new regime of taxation that was introduced by Finance Act 2020, which was section 115 BAC, wherein an individual or HUF can go for this scheme of taxation and there was a simplified regime of slabs wherein the income could be taxed, vis-a-vis your complex regime of taking benefit of 80C, 80D and all those exemptions for medical insurance or your health or your life insurances and all those things. So this interest, dividend or rent, it will be taxed as income from other sources. Now only downside of taxing it as income from other sources would be that I do not get many deductions from it, because the deduction is linked to the source of income. If I have not incurred anything in relation to earning of that income, that's a basic funda. It can be different basis, the different sections of provisions that are available. But the basic funda is that if there has to be a live linkage or a nexus between the earning of my income and the expenditure that I incur. So that has been kind of widened. Now these receipts in the hands of the unit holders will be taxable as income from other sources. Not the way it was received by, let's say, there's a infrastructure trust who's owning an X infrastructure. From that infrastructure, the trust is receiving a rent income. Now for the rental income, if it comes in my hand, I may get a standard deduction. But that has been curbed and widened, that now it will be only taxed as income from other sources, not as the rental income that the infrastructure trust is getting. The only thing is that it should not be the income exempt under section 1023 FC and FCA. So there is new category of taxation for that is new section that has been introduced, section 50AA, which is about the taxation of market linked debentures, and it has been held to be that this will be taxable only as short term capital gains. So it will not be, there will be no other category. This section 15AA income, yeah please.
Sorry for interrupting.
No, please.
Sir, just in the case of house rent property, say a person owns 5 houses and he is letting them out for and he, as a business, he earns just the rent. So will that fall under income from other sources or house foundation or PGBP?
So, may I know your name please?
I'm Akshit.
Akshit, there is like two things about it. One is that if I'm doing a simpliciter rental income kind of a situation, like I'm just giving on rent, the properties are lent out and I'm earning rent out of it, then it will be taxed as income from house property. If let's say I'm into a business of giving those properties on rent and I'm doing something more than just simpliciter renting of those properties, then in that situation the courts have held that it can be income from business also. Or otherwise there could be another category depending on the facts of the case, that whether it is income from other sources, but this category is, I would say, not that relevant for this type of income. It will be either income from house property or income from business, depending upon what type of activities you are doing and the way you have housed or structured your income. So it can be both, but conservative house property. If you are actually into business, doing something more, let's say income from malls, you're giving shops on rents, you're giving infrastructure facilities, you're also providing the manpower to take care of the shops and the other infrastructure around it. Yeah, the, what is that called? Housekeeping services. So then it's a business income. So I was on this market linked debentures. I just read out the definition of market linked debentures. Sorry, I can't remember everything. So the market linked debentures have been defined in the Act itself, which says a security by whatever name called, which has an underlying principal component in the form of a debt security, and where the returns are linked to the market returns on other underlying securities or indices, and includes any security classified or regulated as a market linked debenture by Securities Exchange Board of India. So this is how it has been defined. So the only thing that I want to point out here is that this will be taxable as short-term capital gains, and this is a new stream which has been carved out. Then there is this clarification on interest computation for defaults and payment of advance tax. So earlier by Finance Act 2022, there was a new category of return filing that was brought. That was updated returns, filing of updated returns. Earlier there was a category called rectification of my returns. I can file a rectified return. But now they have brought in a new category of filing updated returns. So there was a confusion that how the interest for your income is to be computed. That confusion has been removed by this section. Then there is this angel tax. The angel tax is not a term used under the tax laws. It's just a commercial term that is being used, and why it is called angel tax? Because it's an income it's a tax on your notional income. So what used to happen is that if I as a company issue shares to a resident, and let's say I have issued shares at an extraordinary price, then the company actually is getting benefited. Let's say the market value or the fair market value of that share price was 100 rupees. I issued it at 150 rupees. So the company got 50 rupees additional. So that could be an unaccounted money. So to plug that, this section was brought in quite a number of years ago for the residents only, where a resident is transacting with the other resident. Now this section has been extended to the non-residents as well. But this actually, the scheme of this section is to curb the unaccounted money. Now whether a non-resident is bringing in unaccounted money because it is coming through banking channels is a question of law which may get debated before the courts. And in fact, it is getting debated before the courts. But that is, just to curb that, they have brought this amendment. Let's see how this is interpreted by the courts. The last one I have already covered in the startup thing. Now then, there is this rationalization of tedious provisions. So the first one I have already covered. The second one is like when you file your tax returns, maybe your TDS is shown in the next year's, you get a Form 26AS, if you are aware of Form 26AS. Your TDS is shown in that Form 26AS which has been deducted by the payers of that income. Now, once the TDS comes in that Form 26AS, let's say it pertains to the next financial year. But your income, you are declaring that income in this financial year. So the officer may not grant the credit of those taxes properly. Now to get away that anomaly which was actually coming in for getting all these things rectified. So it was creating a lot of litigation, which is a minuscule litigation and frivolous litigation which was of no use for anybody. So to curb that and to reduce the loads of the court, this has been rationalized so that now you can get the credit at the AO level itself, if the AO is diligent enough to give you that thing. Then this is an interesting point, the NRDTAA rebate. Now, there are certain streams of income which are taxable under the Act and may not be taxable by virtue of DTAA. DTAA is double taxation avoidance agreements, which are entered between two countries. So let's say India has entered some agreement with US. Now there are a lot of things under the international tax and it's a wide area. Now I'll just give you an example with respect to this bullet that I'm discussing about. Let's say there's a fee for technical services and royalty income. Royalty income is that if I, let's say, there is a kind of use of a hardware, let's say computer, so then I may earn royalty income, or a server, then I may earn a royalty income. By giving the right to use of that equipment, XYZ thing, there are various connotations to it. Now, if I'm let's say giving you technical services, or the royalty income is there, earlier the scheme was, or even now the scheme is, that either the Act will apply and the rates under the Act will apply, or the rates under the DTAA will apply. Now, if let's say the rates under the Act are lower vis-a-vis the DTAA, then whatever is more beneficial to me will apply. So earlier what had used to happen was this 20% was 10% under the Act, and most of the DTAs used to have 15% as the rate of taxation. So the people or the taxpayers were actually taking the use of or were getting taxed under the Income Tax Act or the domestic law, because that was more beneficial to the taxpayers. Now, to curb that practice, because they saw that this is in a way, India is losing its the legal revenue, or a lot of revenue was getting leaked because of this. So they increased this to 20%. And then the second one is just a condition that applicability of DTAA rates and all those things which I just discussed. And TRC is kind of a document received from the overseas jurisdiction to get your validity that yes, you are a resident of that country and you get the benefit of that DTAA. Because without a TRC, you will not get the benefit of the DTAA. Though international taxation is quite a complex subject, it's not that easy what I have spoken about in the bullet. If somebody wants to read it, if somebody has to read it, it will go long way. And it's, even today I am not an expert in international taxation. Though I have been doing international taxation for last 20 years or so. It's quite a vast area and an interesting area. And the best part of international taxation is that it's a universal law. Even the transfer pricing is a universal law. It's not that it's contained to India only. So if somebody has to practice international law or the transfer pricing, then the world is the horizon. So then there are, this is just a nominal thing that, let's say if there is a super senior citizen who is not liable to file return, does not have a PAN number, then he may get if the PAN number is not there, then the TDS will be deducted at a higher rate. So they'll notify the specified period, and then those specified persons can, the TDS may not be at a higher rate, or the TDS may not be even there. So this is, there was a new entry that was brought in earlier, I think it was by Finance Act 2020 or 21, wherein the tax collection of TCS means tax collection at source. So tax collection at source used to happen if somebody is selling overseas packages, the excursion packages or travel packages. So if those things were happening, there was a TCS that was to be collected at 5%, and now that has been increased to 20%. So any idea from this group that why government collects TDS or the tax reduction at source? Any idea about it? Why do we do it? It's a very common, nothing related to my slides or law. So I'll have a sip of water till the time you think over it. See, in law there is never a right or wrong answer. I can say I am wrong, I can say I am right. So there is never a right or wrong thing. It's all about interpretations.
Revenue for government.
Pardon?
Revenue for
Yeah, correct. That's the right. In a short form, that's the right thing, because TDS is pay as you earn. That's what the, yeah.
Just to record the taxation system.
Yeah, so there are 2-3 benefits. One is the pay as you earn, as my friend over here said, that revenue for the government, because government also has to spend. Like, I used to get my pocket money, you may be getting your pocket money. So without that, you won't be able to survive. Because on a monthly basis or a weekly or a daily basis, I need something for myself to survive. So if I only survive on advance tax, then that advance tax comes after 3 months or 6 months or the quarterly basis, I mean to say. But TDS comes on a daily basis or a monthly basis or whatever the term of that payment is. So therefore, it is pay as you earn, and plus certain people may not be paying. Like in foreign countries, we don't even have income tax. Some of the countries we don't even have income tax. We've got straight away the GST or the service tax, wherein they are just levying every item. Every item, it's a tax on commodity. So there is no revenue leakage. Similarly, here also, few of the provisions that I just mentioned, it's only to curb the revenue leakages, that if I'm not paying taxes or if I'm not filing my tax returns, then through these venues or through these yes. So then there are certain small changes in transfer pricing provisions. So I just dealt with transfer pricing provisions in my first slide. Any idea that what is transfer pricing? It's a simple, I'm only asking the English meaning of transfer pricing, I'm not asking the legal meaning of transfer pricing. Again, this is a universal law. All over the world, the fundamentals are similar of transfer pricing, and it's a huge, it has got huge impact for taxpayers all over the world. See, transfer pricing is when I transact between, there's a transaction between you and me. So, and let's say we both are related parties. If it's an unrelated party or a transaction between unrelated parties, then there is no transfer pricing involved, because an unrelated party, you will not give me any undue concession for the transaction that you are doing with me. But in an unrelated party, if let's say I am doing a transaction, I am just giving a simple example, I am doing a transaction with my brother, then maybe out of love and affection, I may give some concession to my brother for, let's say, the goods that I have sold to my brother. So there, the government, so this normally always I would say, the transfer pricing transactions happen between two jurisdictions. One is the resident, which could be a resident of India, and the other would be a non-resident, which could be a resident of any country. Now, when that transaction happens, let's say I want to give my other counterpart or my group company a benefit. So the taxation department would want to curb that so that there is no business profit erosion for India per se, and India gets its due share of taxation from that transaction. Now that is what is called transfer pricing. Though these amendments are not relevant per se for you, so I am just explaining you the concept of transfer pricing. So that is what is more relevant for you. So transfer pricing is again a very complex law. It has got its own methods, all those things. And it's a very interesting subject per se. Even most of the, whenever I go to the tribunals for arguing matters for transfer pricing, even the departmental representatives today are scared of representing for the department side. They say that if they are, let's say, they are a regular corporate tax assessing officer or a commissioner, they would say we don't know that if they come for a routine or a rotational duty. They'll say, let's do it some other time. That's how it is. But it's a very simple economic concept, but yes, very interesting because it deals with economics and commercial principles on a daily basis. So these are a few amendments which I don't think would be too relevant for at your stage. Then these are few procedure changes. There's a section called 148, which is a reassessment section. wherein if let's say the officer has discovered some escapement of income, he will issue me a notice for reassessment of my income. Earlier there was no defined parameter or timeline for filing of the return. Now that has been done to 3 months. Though it's a good thing, but earlier also there was some, I would say, kind of a guidance that in 30 days one has to file the return. But this has now been crystallized to 3 months. But the only thing, bad point here is that, or I would say this may be rectified, because if after 3 months I have got justified reasons to file my return belatedly under this provision, then whether I'll be able to do it or not. Today there is no clarity on that. The next one is issuance of reassessment notice. So there is just a small timeline. Let's say if there is a search and seizure operation that has happened on somebody and it has happened on 15th of March. I have to issue a notice under 148 to assess that person's income or reassess that person's income. Then in that situation, if 15th March is the search date, I may not have the complete 15 days time period. So that 15 days time period has been extended by another 15 days. So that mechanism is there to calculate at where the limitation would end, but there's a kind of provision created for extension of the time period, if the timeline is short. Then some undervaluation. This is again a health measurement kind of a thing, wherein the officer can make reference for measuring of inventory or valuation of inventory. Then there is a new appellate authority that has been introduced, because today, if you would have read, there is a faceless regime that has been brought under the Act, under the GST as well as under the Direct Taxes Act. So that faceless regime has created certain backlog, and similar thing has happened with the Commissioner of Appeals at the first appellate authority before the direct taxes, and even at the adjudicating level of the GST. Now, because of that, under the direct taxes, they have formed this new authority called JCIT. JCIT will Joint Commissioner of Income Tax Appeals, which was earlier only Commissioner of Income Tax Appeals. This authority has been formed to do away with the or to dispose of the small cases, so that the backlog gets reduced at the department level and you get the due share of the government that gets the due share of revenue. So again, these are all procedural changes. One is with the realignment of timelines of the assessment. I have already spoken about that there are various timelines. So those timelines have been realigned. Similarly, there is a rationalization of appeals to the ITAT, because certain penalty orders which have been introduced or penalties which have been introduced now have been made appealable. And then the order, so there is this revision jurisdiction which is being exercised. In addition to that 148 jurisdiction of reassessment of assessment or of income, there is a revisionary jurisdiction if an order is prejudicial to the interest of the revenue, an order passed by the lower authority which is prejudicial to the interest of the revenue. That order can be revised by the higher authority, which is CIT. Now, since there are new hierarchies as well in the department, which is PCCIT and CIT. This is Principal Chief Commissioner of Income Tax and the Chief Commissioner of Income Tax. So, since these authorities have been being brought into picture or statute, therefore, now the Section 263 order passed by these authorities will also be appealable to the ITAT. Then there is a concept called cross objections. Now, what is cross objections? Let's say I have filed an appeal and you are aggrieved by it. So earlier, to file a cross objection before the tribunal, only the taxpayers had a right to file cross objections. In that case, I don't have to file an appeal per se. My cross objection will get converted into a regular appeal. Now they have given that right to the department as well to file cross objections. So this is the only change that has been brought in. Then this is again some rationalization for strengthening search and seizure operations. The last one is this corpus. So we have got various NGOs, trusts and all, and they get corpus by way of donations, etc. Now, if I spend something from corpus of the corpus is the basic element or the body of the funds that there as a with the NGO or the trust. I earn income from that corpus, that is a different thing, and that I have to apply for the purpose that I have formed. But as far as my corpus is concerned, that has to remain intact with me. Now, if I use that corpus or I have taken a loan and I use that loan for the objectives that have been formed, then earlier there was no limit to replenish that corpus or to return that loan. Now there is a limit of 5 years under which I have to either return the loan that I have taken or replenish my corpus if I use something from my corpus. Because if I don't do it, then it will not be taken as an application of income in the year when this was to be done, or therefore it will become my taxable income, and the firm will, the trust will not get the exemption on that portion of amount which has not been done within that period of 5 years. So earlier there was no limit for that. Now they have done a limit of 5 years. Though again, this is a limiting rule. I don't know how beneficial it would be, but yes, that's how at times there is no equity in tax laws. So that is how it happens. So the last one is treatment of donations. If I give a donation to other trust, then it was earlier the complete exemption was available. Now it is only to the extent of 85%. So any thing that you want to know, any questions, anything, not related to slides, anything, most welcome. Then I'll move to indirect tax.